Someone turning 65 today has almost a 70% chance of needing long-term care at some point in their remaining years, and the median cost of a nursing home is now over $111,000 per year. Yet most Americans have no plan for how they will pay for it. Today we are going to break down everything you need to know about long-term care planning so you can protect your retirement savings from what many financial experts call the single biggest uninsured risk in retirement. Welcome to the Retirement Classroom. If you are new here, we publish deep dive retirement education videos every week. Hit that subscribe button so you do not miss a single one. Before we get into the details, a quick note. This content is for educational purposes only and should not be considered individual financial guidance. Everyone's situation is different. Please consult with qualified financial professionals before making investment decisions. If you are looking to speak with a retirement professional about your unique situation, scan the QR code on screen or check the link in the description. Let us start with the numbers that make this topic so critical. According to the Department of Health and Human Services, 70% of adults who survive to age 65 will develop severe long-term care needs before they die. The average person who needs care will require it for 3 years. But that average masks a wide range. Women need care for an average of 3.7 years. Men need care for an average of 2.2 years. And 20% of people turning 65 today will need long-term care for more than 5 years. Here's what makes this even more challenging. Only 48% of older adults with severe needs receive any paid care at all. The rest rely entirely on family members and unpaid caregivers. And only 24% receive more than 2 years of paid long-term care. That means the financial burden falls overwhelmingly on families. Now let us talk about what long-term care actually costs in 2026. According to the Care Scout Cost of Care Survey, the national median costs are staggering. A semi-private room in a nursing home costs $111,325 per year. A private room costs $127,750 per year. An assisted living community costs $70,800 per year. Home health aid services cost approximately $60,000 per year for 44 hours per week. And adult day health care costs $24,700 per year. These costs have been rising at 5 to 10% annually, far outpacing general inflation. Here is the critical thing most people get wrong. Medicare does not cover long-term custodial care. Medicare will cover up to 100 days of skilled nursing care after a qualifying hospital stay, but only if you need skilled medical care like physical therapy or wound care. The moment your need shifts to custodial care, which means help with daily activities like bathing, dressing, and eating, Medicare stops paying. Most long-term care is custodial, not skilled. This means Medicare covers almost none of what most people actually need. So, how do you pay for long-term care? There are 4 main approaches, and each one has significant trade-offs. Approach number 1 is traditional long-term care insurance. This is a standalone insurance policy that pays a daily or monthly benefit when you cannot perform 2 or more activities of daily living. The average annual premium is approximately $1,700 for men and $2,675 for women. These premiums increase with age, so buying at age 55 is significantly cheaper than buying at 65. The major advantage of traditional policies is leverage. You pay relatively modest premiums and receive substantial benefits if you need care. A policy might cost $40,000 in total premiums over 20 years, but provide $300,000 or more in benefits. The major disadvantage is premium risk. Insurance companies have dramatically underestimated how many policyholders would need care and how long they would need it. As a result, many carriers have raised premiums by 50 to 150% on existing policyholders. Some states, like New York, now have only one company still selling new traditional policies. And if you never need care, you have paid premiums for decades with nothing to show for it. Approach number 2 is hybrid long-term care insurance. These policies combine life insurance with long-term care benefits. If you need long-term care, the policy pays for it. If you never need care, your beneficiaries receive a death benefit. Either way, the money does not disappear. Hybrid policies cost 2 to 4 times more than traditional long-term care insurance because they provide dual benefits. A typical hybrid might require a single premium of $75,000 to $150,000 or annual premiums of $8,000 to $15,000. In return, you might receive $250,000 to $500,000 in long-term care benefits, plus a death benefit. The key advantage of hybrid policies is locked-in premiums. Unlike traditional policies that can increase premiums, hybrid policy costs are fixed at purchase. The disadvantage is the much higher upfront cost. You need significant capital to purchase a hybrid policy, and that capital could otherwise be invested for growth. Approach number 3 is self-insuring. This means setting aside a dedicated pool of assets specifically for potential long-term care needs. If the average care duration is 3 years and nursing home costs are approximately $111,000 per year, you need roughly $350,000 earmarked for long-term care. If you want to plan for a 5-year need, that number rises to over $550,000. Self-insuring works best for affluent retirees who have assets well beyond what they need for retirement income. The advantage is complete control. There are no premiums, no insurance company decisions, and no risk of denied claims. If you never need care, the money remains part of your estate. The disadvantage is opportunity cost. $350,000 sitting in conservative investments for a potential future need is money not growing in your retirement portfolio. And if you need care for longer than expected, you could still exhaust your self-insurance fund. Approach number 4 is Medicaid planning. Medicaid is a joint federal and state program that covers long-term care for people with very limited assets and income. In most states, individuals must have less than $2,000 in countable assets to qualify. A married couple can protect a community spouse resource allowance, which varies by state, but is typically around $150,000. Some people use irrevocable trusts to protect assets and qualify for Medicaid. Assets placed in an irrevocable trust are no longer counted as yours for Medicaid eligibility. However, there is a critical 5-year look-back period. Any assets transferred within 5 years of applying for Medicaid trigger a penalty period during which Medicaid will not pay for your care. This means Medicaid planning must start at least 5 years before you might need it. The advantage of Medicaid planning is that it protects assets for your heirs while using government benefits to pay for care. The disadvantage is that Medicaid typically only covers care in nursing facilities, not assisted living or home care. And the nursing homes that accept Medicaid may not be your first choice. You also lose control of assets placed in irrevocable trusts. Let me walk through a practical example to show how these approaches compare. Meet a hypothetical couple, both age 60. They have $1.5 million in retirement savings and receive $48,000 per year from Social Security. Their retirement expenses are $72,000 per year. With traditional long-term care insurance at approximately $4,000 per year for both, they spend $80,000 in premiums over 20 years for up to $600,000 in combined coverage. With a hybrid policy, they invest $150,000 in a single premium hybrid. If one of them needs 3 years of care, the policy pays out $300,000. If neither needs care, their children inherit $150,000. With self-insuring, they earmark $350,000 from their portfolio. This reduces their investable assets to $1.15 million, but gives them full control. With Medicaid planning, they work with an elder law attorney to create irrevocable trusts now at age 60, well before the 5-year look-back window. There is no universally right answer. The best approach depends on your health history, family longevity patterns, asset level, risk tolerance, and estate planning goals. Many financial professionals recommend a blended approach. Use self-insurance for the first year of care, combine it with a traditional or hybrid policy for years 2 through 5, and have a Medicaid backup plan for catastrophic needs beyond 5 years. Here are the key takeaways. 70% of people turning 65 will need long-term care. The average need is 3 years, but 20% will need more than 5 years. Medicare does not cover custodial long-term care. Nursing home costs now exceed $111,000 per year nationally. Traditional long-term care insurance provides leverage, but carries premium increase risk. Hybrid policies lock in premiums, but cost 2 to 4 times more upfront. Self-insuring requires $350,000 or more in dedicated assets. Medicaid planning requires a 5-year look-back and limits your care options. The best time to plan is in your 50s or early 60s, when premiums are lower and you are more likely to qualify medically. If this breakdown helped you understand long-term care planning, hit that subscribe button and turn on notifications so you do not miss our next deep dive. We publish new retirement education every week.
Hey, before you go, if you're serious about your retirement, we'd love to help. Scan the QR code on screen right now or visit the link in the description to book a completely free strategy session with a qualified professional. It only takes a couple minutes to fill out, and there's absolutely no obligation. Take the first step today. We'll see you in the next one.